In 2025, President Trump said, quote, "You better go out and buy stocks now." And immediately after he said that, the stock market broke new record highs again and again and again. Some people said it was market manipulation, but other financially savvy investors use this information to make a lot of money relatively quickly. Well, here we are in 2026, and it just happened again. In the last few days of December, President Trump gave a speech where he promised an even bigger economic boom in 2026. Take a listen.
We're poised for an economic boom, the likes of which the world has never seen.
But that's not all. After President Trump said that, Treasury Secretary Scott Bessent went out to the public and he said the economic growth that we saw in 2025 is just a taste of what we're about to see in 2026. Take a listen.
2025 was setting the table, and especially on the economy, I think the feast and the banquet's going to be in 2026.
Now, of course, nobody has a crystal ball to predict what's going to happen in the stock market, but what we do know is that the United States government today is spending more tax dollars to keep the stock market booming in 2026. Now, the people that understand this are going to be able to grow their wealth faster, but the people that don't are going to slowly be left behind, which is why it is so important for you to understand this shift that's happening today, which is what I'm going to break down in this video. And then I'm going to show you how you can find the investment opportunities through the changes that we're seeing. So please stick with me until the end of this video. And the reason why this is so important to understand now in 2026 than ever before is because investment opportunities are changing faster than ever before. We have changes with AI, we have government policy changes, we have Federal Reserve Bank money changes, and all these changes create new and unique investment opportunities that you don't want to stay behind, you want to be ahead of. And this is why, to start the new year off right, on January 13th, 2026, I'm hosting a live and free investor workshop where I'm going to be going over how our economy is changing and how these changes are going to create new and unique investment opportunities. That way you can find better places to invest your money. Hopefully, can't guarantee anything, but based off of data and research. It's a completely free workshop. It's a live workshop. I'm doing it twice on January 13th, once in the morning at 10:30 a.m. Eastern Time, and then again in the evening at 8 p.m. Eastern Time. It's a completely free workshop. There's going to be a lot of value that I put out there with research as to where the economy is moving. So if you're an investor and you want to see how these changes are going to create better investment opportunities for you, I invite you to join me on this workshop for free. But I have one small request. If you're interested in joining, please do so soon, because we have a limited number of people that can join me live on our software. And every time I've done a live workshop like this in the past, we've either hit capacity and had to turn people away, or we were close to hitting capacity. So please reserve your spot soon. I'm doing it twice, once in the morning at 10:30 a.m. Eastern Time, and then again in the evening at 8 p.m. Eastern Time. So if you'd like to join me on this live investor workshop on January 13th for free, all you have to do is register, and I have the link for you down in the description below. In early 2025, President Trump said that you need to go out and buy stocks now because he was finalizing tariff deals with foreign countries. Now here we are in 2026, and President Trump says that our economy is going to boom even faster this year than last year because of three reasons. Number one are lower interest rates coming in 2026. Number two is government stimulus for the stock market. And no, I'm not talking about stimulus checks. And number three is not letting the stock market collapse. So let me break this down one by one, starting with lower interest rates. There are two types of interest rates that you want to pay attention to. Number one are retail rates. These are your mortgage rates, your car loan rates, your student loan rates, your credit card interest rates. When you go and get a loan, this is the retail interest rate. The other type of interest rate that you want to pay attention to, though, is the federal funds rate. This is the interest rate set by our central bank here in the United States. It's called the Federal Reserve Bank. And this interest rate set by the bank, the federal funds rate, is the interest rate that banks get to borrow money from each other at. So you can think of it kind of like the wholesale rate to borrow money. Banks borrow money at a certain interest rate and then they sell it to you at the retail rate. This is what President Trump has been demanding should go down. President Trump has been asking for 1% federal funds rate. That would bring us down to some of the lowest levels that we have seen really ever. It would bring us close to the pandemic levels, not all the way down to the pandemic levels, but close to the pandemic levels where we saw the lowest interest rates in the history of all time. If we see lower federal funds rates, banks get to borrow money at lower interest rates, which means you might be able to get cheaper retail rates. It's not directly linked, but if banks borrow money at a cheaper rate, they can sell it to you at a cheaper rate. Now you're probably thinking, well, Jaspreet, what's so special about 2026? Why didn't President Trump just do that in 2025? Because the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're actually not federal. It says so on their website. They're not a part of our federal government. They're actually not a bank because you and I can't go there to deposit money, and they're actually not a reserve either because they're not sitting on any cash reserves. But because they're not federal, President Trump cannot directly tell the Federal Reserve Bank what to do. And the chairperson of the Federal Reserve Bank is going to have his term expire on May 15th, 2026. And when his term expires, President Trump is going to pick a new head of the Federal Reserve Bank. And President Trump has said that he's not going to pick anybody who is going to disagree with what he says, which means we can infer that President Trump is going to want to bring in somebody who is aggressive in cutting interest rates. So we're going to have to wait to see what's actually going to happen when it comes to interest rates. And if interest rates go down, that doesn't just mean that people might buy more houses or buy more cars because interest rates are lower, but that could also mean that big institutions and banks and hedge funds on Wall Street could borrow more money that they can dump into the stock market because they're also big borrowers. And prices of stocks on the stock market run on supply and demand. When there are more buyers than sellers, the price of stocks go up. So if Wall Street institutions are borrowing money to buy more stocks, that could mean more buyers of stocks, which could push stock prices higher. Now, of course, we don't know what's going to happen just yet, but this is what brings us to number 2, more government stimulus, especially for the stock market. And this is where I gotta give you the disclosure. Investing has risks. You are never guaranteed to make money when you invest. And in fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now, when most people think about government stimulus, they're thinking about stimulus checks or these tariff rebate checks. But that's not what I'm talking about. Although what we've seen from the past is anytime stimulus checks go out, that also boosts the stock market because then people take that money and they spend it at corporations that are trading on the stock market. So these corporations make bigger profits and their stocks go up. But that's not what I'm talking about. I mean, certain government policies which are going to benefit certain stocks more than others. I mean, money printing, which can benefit the stock market. And I mean, deficit spending, which benefits the investor. Let me start with policy because it goes without saying that the Trump administration has really changed our economy. Tariffs have impacted our economy in many ways. One of the ways is that China, in response to these tariffs, have limited the export of rare earth metals to the United States. Now, what does that mean? All you got to understand is that there are these metals that are used in pretty much every part of our business. They use them in iPhones, you use them in computers, use them in our defense systems. We need them to run our economy, but we've been relying on China to get these metals. Now that China is not giving us as many of these metals, the United States has to create more of these metals ourselves, which isn't an easy thing to do. And this is where these rare earth metals have to be produced outside of China. And so the Trump administration has passed executive orders to make it easier for rare earth businesses to start and operate here in the United States. Which means those companies, those rare earth companies, now have brand new government policies which allow them to start and grow their businesses while the demand has skyrocketed. We've also seen an explosion of AI in 2025 and 2026, but in order to fund and fuel this AI, we need data centers. And that's where the Trump administration has passed new executive orders to make it easier to build and fund these data centers here in the United States. But this is where things really get interesting because it's not just that the government is changing policies, they're also putting their money, well, actually your money because it's your tax dollars. The government is putting your money where their mouth is by investing their money into these companies. For example, when it comes to rare earth minerals, like we just talked about, the Trump administration has invested in rare earth mineral stocks like MP Materials. The United States government has invested hundreds of millions of dollars into that stock to own a piece of it to hopefully see that company grow. When it comes to AI and technology, the United States government has invested billions of dollars into the Intel stock to hopefully see growth in that industry as well. This is not just a shift in government policy, but a shift in how the government does business because now we're seeing the government pave the way for certain industries to benefit, but we're also seeing the government invest in those same stocks on the stock market, which is something you may want to pay attention to as an investor. Then when it comes to money printing, what we know is that when more money is created, the investor generally benefits. There are 3 entities in our economic system. I call it the C, the I, the B, the consumer, the investor, and the businesses. You as a consumer, everybody's a consumer. Rich people, middle class people, poor people, everybody's a consumer. You go to businesses and you spend money. This might be Chipotle to buy the guac. This might be Walmart to get clothes. This might be Apple to buy a new iPhone. But you go to a business and you spend money, but the real beneficiary isn't the worker in the business. It is the investor in the business because all the extra money that you spend goes to the profits which are owned by the investors. But this is where things get interesting because when inflation happens, that means that, well, you got to pay more money for the extra guac. Your iPhone becomes more expensive. Walmart stuff becomes more expensive, which means consumption is more expensive. So you as a consumer now spend more money at the business. Well, when you spend more money at the business, who's getting all these extra dollars? Is it the workers? Well, no, they might get a little bit of a raise, but all the extra dollars are going into the profits, which are owned by You guessed it, the investors, which means all those extra dollars are going into the hands of the investor. So when you see more money printing happen, when you see more inflation, the beneficiary is the investor, which is why you got to be an investor. And what we know is that the Federal Reserve Bank has committed to do more money printing in 2026. The Fed actually stopped money printing in 2022. They started a program called quantitative tightening. Because of all the inflation that we saw in 2020 and 2021 and the first half of 2022, to fight that, the Fed started quantitative tightening, which is trying to reduce inflation by pulling money out of our economy. So for the second half of 2022, we saw money being pulled out. 2023, the Fed was pulling money out. 2024, the Fed was pulling money out. 2025, the Fed was pulling out until December 1st, 2025. That was when the Fed announced the end of quantitative tightening. And then one day after that, December 2nd, the Federal Reserve Bank printed $13 billion to inject it into our economy. And immediately after that, the Fed said $13 billion was not enough. So then they committed to printing an additional $40 billion a month to continue to keep our economy moving and strong. That money printing creates inflation. That inflation means consumption becomes more expensive, and that consumption benefits the investor. And this is not going to slow down in 2026. It just started in the tail end of 2025. We're going to see more of that in 2026. And then, of course, it is deficit spending. Our economic system runs on spending. The more money you spend, the more money somebody else makes. If you go and spend money at Chipotle, it is good for Chipotle. If you go out and spend money you don't have at Chipotle because you financed the bowl and the extra guac on your Amex, it is good for Chipotle. It is good for the Chipotle investors. Well, do you know who the largest spender in our economy is? It's not me or you. It's not Amazon or Nvidia or Tesla. It is the United States government. And the United States government has one source of revenue, tax dollars from taxpayers. But they've been spending money they don't have. This is called deficit spending. And what we know is that in 2026, the United States government is expected to have around a $2 trillion deficit, which means they're going to generate around $5 trillion from taxes and then spend an additional $2 trillion that they don't have, which is good for spending, good for the economy, which means it's good for the investor. But the person who pays the price is the employee and the consumer, because that means their wages generally don't keep up with inflation, the price of things are growing, and the investor is the one that's getting rich. And this brings us to point number 3, not letting the stock market collapse. So what we know right now is that President Trump has announced publicly that the economy is going to boom faster than ever in 2026. After he said that, the Treasury Secretary then went out and said that we're going to see an even faster economic growth in 2026. The reason why they're saying that is because, number one, they want to see lower interest rates because of changes at the Federal Reserve Bank. In addition to that, number 2 is because of stimulus. We're talking policy stimulus, which is the United States government changing economic policies which are going to benefit certain stocks, but also the government putting your money where their mouth is by taking tax dollars and investing it into public stocks on the stock market to help these stocks and hopefully the stock market continue to grow. Then number 2, we talked about money printing, where the Federal Reserve Bank changed their policy on December 1st, 2025 to be more towards quantitative easing, to be more for money printing. And we're going to see that continuing in 2026. And then also with deficit spending, where the government is going to spend approximately $2 trillion that they don't have in 2026 to continue stimulating the economy. And now let's talk about how the government does not want to see the stock market fall or really collapse and different things that they're doing. Again, this is why becoming an investor is so important. And this is where investment opportunities are shifting. And this is where, again, I have my live and free investor workshop on January 13th, which you can join. I have that link for you to register down in the description. Up until now, in this video, I've been talking about the health of our stock market, but the health of the United States stock market depends on the health of the United States government and the United States dollar. And what I talked about just a minute ago is that the United States government does something called deficit spending, which means they're spending money that they don't have. Now, how does the government finance this deficit spending? It is through debt. Now, who does the United States government borrow this money from? It could be from regular people like you and me. It could be from banks on Wall Street. It could be from corporations. It could be from foreign countries like Japan and the United Kingdom. But it can also be from our central bank, the Federal Reserve Bank. Now, historically, the Federal Reserve Bank is kind of like the last resort to lend money to the United States government, because although they're called the Federal Reserve Bank, they're not federal. It's not a part of the United States government. They're not a bank because you and I can't go there to deposit money, and they're not a reserve, which means they're not sitting on any cash reserves. So the United States government's debts have to be funded somehow. And we know that the government has been borrowing a lot of money that they don't have. We've racked up over $38 trillion worth of national debt. Now, here's where things get interesting. What we've been seeing happen over the last number of years is that people have been less interested to lend money to the United States government at some point or time. Sometimes it's foreign investors, sometimes it's investors here in the United States, but we've been seeing different groups of people not wanting to lend money to the United States government for one reason or the other. Maybe they're concerned about inflation. They're worried that the United States government is not paying back high enough interest rates. They're concerned about the United States economy. And so when we see these concerns about people not lending money to the United States government, that creates a problem. Because if the United States government doesn't have money to pay their bills, well, that could mean that the United States government has to declare bankruptcy. They default. And if the government defaults on their debt, that's a problem, not just for our stock market, but for the global economy, the global markets, because the entire world relies on the dollar. Remember, the United States dollar is the world's reserve currency, which means the world's trade happens on the dollar. So if the United States government cannot get this debt to pay their bills, well, that's going to be a problem, because that means the government can't pay their bills. And if the government's not paying the bills, people are not getting paid back. It's going to cause a collapse the like of which we have never seen before, because the whole world is relying on the government to pay back their bills. And what we've been seeing is, well, we've been seeing concerns of people wanting to lend their money to the government for one reason or the other, like I just talked about. And this is where what we've been seeing happen is the Federal Reserve Bank has been coming in to fill that void more and more and more. That when the United States government wants to spend money that they don't have and the government cannot raise enough money, they're leaning more to the Federal Reserve Bank to then print this money to lend it to the government in exchange for interest. And this is where you talk about not letting stocks collapse. If the Federal Reserve Bank ever started to slow down that printing for the United States government, it would create an implosion. And this is where the Federal Reserve Bank has essentially said, hey, government, whatever amount of money you want to spend, which we know stimulates the economy, it stimulates the stock market, it's not good for consumers, it's not good for average workers because it causes inflation. But the Fed has said, whatever you want to spend, which stimulates this, we will continue funding. And they've been funding it and funding it and funding it, even if the government can't borrow this money from somewhere else. And this is where the government now has the ability to indirectly influence the stock market, because if the government wants to spend money, that spending means the government might give more contracts to these businesses that trade on the stock market. It could even mean that the government is directly putting their money into the stock market, which we've been seeing happen in 2025, which is not a normal thing for the United States. But now, the government's been struggling to get this debt, and that's where the Fed has been stepping up. And they're saying, you know what, government, you spend whatever you got to do, keep stimulating the stock market however we want to do it, we'll be there to support you anytime you need. This is where it is so important to understand the implications of this, because our entire economic system is now designed to make the investor rich. It's designed to support the investor. It's designed to backstop the investor. Now, this doesn't mean that markets are not going to go down. It doesn't mean that markets can't go down. It doesn't mean that we're not going to see a market crash. It does not mean that we're not going to see a recession. All those things happen. But what we know now is that the stock market has the government supporting it. The stock market has the Fed supporting the stock market, and the stock market has the Fed supporting the government, which is supporting the stock market. So this is how our system is now evolving. And either you can understand it and use it, or you can hate it. Now, you can pick whatever you want, but at the end of the day, this is what's happening. And my goal is to teach you what's happening. That way you can take advantage of this. And this is where, again, it is so important for you to become an investor, and one of the simplest things you can do is just invest your money into the market. And the way you can do that is you can invest in the fund that's giving you broad exposure to the stock market, something like the S&P 500, something like the total stock market. There are ETFs out there, funds that will give you exposure to that. For example, SPY. SPY is an ETF that gives you exposure to the S&P 500. Or if you're looking for slightly better returns, I'm not talking about trading, I'm talking about slightly better returns. This is where, if you can pay attention to where the government is putting their money, where the government is changing policies, that creates investment opportunities for you. Because now you can invest your money where the government is investing their money. You can invest your money where the government is changing their policies. We've talked about rare earth minerals, how the government has changed policies to make rare earth minerals succeed here in the United States. We've talked about how the United States government has invested directly into rare earth mineral stocks. We've talked about data centers. We've talked about AI, how the United States government not only is changing the laws for certain companies, but they're also then giving these companies money, which trade on the stock market, to help see those stocks boom. And when you understand that, it becomes a lot easier not to fight it, but rather to follow it. Because your job as an investor is to follow the money and understand where the money is moving. That way you can be the winner. That way you can have the ability to take better care of your family, better care of your community, and better care of yourself. Because the reality is this is what's happening. It's not slowing down. It is going to accelerate in 2026. It is going to make some people incredibly rich. Most people are not going to keep up. Most people are not even going to know what's going to happen or that it is happening. But if you understand this, well, now you can grow your wealth even faster by following the flow of money. Again, it doesn't guarantee which way stocks are going to go, which way asset prices are going to go, because every sort of investment is risky. But the more you understand, the more you research, the more you can lower your risks. That's what smart investing is all about. Again, that's what I'm going to be going over on my live workshop on January 13th. I have that link for you down in the description. But if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you. On December 1st, 2025, the Federal Reserve Bank flipped their economic policy by ending QT. What that means in plain English is the Fed went from trying to remove extra money from our economy to now printing more money. How do I know? Because on December 2nd, one day after the Fed ended QT, the Fed printed 13.5